Hello folks, Steve Lentz here with Discover Options with Option View. Welcome to this presentation of several different market reports. This is for Friday ending May 26th, getting ready for Tuesday after Memorial Day, May 30th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. We would love it if you would subscribe by clicking on the button. And also, if you want a free ebook, you can certainly get it by clicking on the link and giving us your information, and we will send you this free ebook co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. We have three market reports for you today. For those of you that trade advanced option premium selling strategies through butters and condors, we have the Butterfly Condor timing report, which will help you ascertain whether now is a good time to put on a butterfly or a condor. It's a great question. Now, some of you like to trade more directionally, particularly from the bullish side in the broad market. And so we have the bull put spread timing report. So whether you're trading just a straight credit spread in the out of the money puts, or perhaps a modified one where you're hedging it, or even perhaps an offset iron butterfly, which leaves the upside a little bit bullish, and unexposed, that second one, the bull put spread timing report, would be something you should be looking at. And then also we have just the raw statistical data in terms of the likelihood that the S&P is likely to go up or down, and that's just a statistical report. We'll get to that at the end, okay? All right, so let's look at the current market condition right now. We are definitely above the 50-day simple moving average. The S&P is certainly above that by quite a bit. Thursday was a strong upswing bar, with the high being higher than the previous day's high and the low being higher than the low being higher than Thursday's low. However, Friday was an inside day that you can see there, a day in which the high and the low did not exceed the previous day's high or low. And so it's an inside day, and all that occurred when the stochastic, the 15-3 stochastic, is in the 90s pretty much. I just say it's between 60 and 99. That makes for a total market character that's very interesting, where the stochastic is above the 3-day moving average, %D, overbought territory, so to speak. So we're in an uptrend, in overbought territory, and we have an inside bar. Okay? That hasn't happened all that often, not even 100 times, since January of 2000. All right, so we're going to go back and look at each one of those incidences and draw from those experiences to see whether we have a good situation for bull put spreads, condor butterflies, etc. Okay, so let's first go to the condor butterfly timing report. And so since Jan of 2000, there have been over 4,300 daily closes of the SPX. Of these, 65.1% have been favorable bars for selling option premium, where the actual 21-bar movement was less than the SIBO skew-adjusted implied movement. Okay, so 65% of the bars ended up being favorable. Also during that time, our current condition, the one I just told you about, has occurred 91 times. Now, of those 91 occurrences, 75.8% of those have been favorable for premium selling, similarly favorable. Okay, now that implies then an edge of about 10.7%, 75.8 minus the 65.1 baseline. Okay, so statistically, it's more likely than normal that Friday's bar will end up being a favorable one for market-neutral option premium selling through strategies like butterflies and condors. Okay, so that's the report there. Very interesting for those of you that trade those advanced strategies. Now looks like as good a time as any in terms of just raw statistical looking at the past and ascertaining patterns for the future you have apparently a strong statistical advantage in this environment. Now, if you like to do bull put spreads, okay, where you're selling put premium out of the money and buying further out of the money puts to cover it, or perhaps you're just selling naked puts, playing on the bullish trade, or if you're doing one of those condors or butterflies where you lean it bullish to take out some of the upside normal exposure you would have, here's the bull put spread timing report we have. Okay, so now of the 4,300 and 37 closes since January of 2000, 82.7% of those have been favorable for selling out of the money put premium, where the actual downside movement was less than the SCIBO skew adjusted implied movement to the downside. Okay, now also during that time, now that's the 82.7 is the baseline. Okay, 82.7% of the time, the market does not go down a full standard deviation. That's what we're saying there, based upon the SCIBO skew adjusted implied movement. Now also during that time, our current condition has occurred 91 times. Of those 91 times, 85.7% of the bars were similarly favorable, where the downside movement, where the actual movement was less than the implied movement from the option prices. Okay, so that gives us an edge of roughly 3%, 85.7 minus the 82.7. So statistically, for those of you bull put spread traders, it's more likely than usual that Friday's bar will end up being a favorable one for selling out of the money put premium. The current market condition we're in will end up being a favorable one relative to the past. Okay, so that's the bull put spread timing report. Finally, let's get to the market likelihood report. And this basically looks at price distribution. Okay, we're not looking at specific strategies as much as we want to simply answer the question based upon the current market condition and how it's worked out in the past. Is the market likely to go up, down, or stay in the middle and do nothing? So here's what we do: is we look at price distribution, and we take a look at distribution bands set 5, 10, and 15 days above the close, 1 standard deviation level, using statistical volatility to determine that particular distance from the close. So here we have an upper band, okay, set 5 days into the future, but 1 standard deviation above the close. Okay, of the 4,337 occurrences since Jan of 2000, the upper band within 5 days gets touched 29.6% of the time. The 10-day band, okay, set 1 standard deviation, a 10-day 1 standard deviation band gets struck 23% of the time. Above the close. The 15-day band above the close gets hit 23.1% of the time. Now that distance is again set by statistical volatility. We have 3 lower bands. The lower 5-day band got struck 29.3 of those 4,300 times, 4,337. The 10-day band set below the close, 1 standard deviation, got struck 29% of the time. And the 15-day band, 1 standard deviation set below the close, 31.8% of the time it got struck. So this is how price is distributed historically. Now, let's go and look. Now, there's 93 occurrences here. 2 of these must have been consecutive, so that's why we have 2 extra ones here. And here, for those 93 occurrences, the upper 5-day band got struck 11.8% of the time, much less than the benchmark 29.6, 17.8% difference. So What this is saying is that the market, after our market condition, the upper band, upper 5-day band, has historically been struck significantly less often. Make sense? The 10-day band got struck 14% of the time rather than 23, 9.3% different. It got struck less often than normal, than the baseline. The upper 15-day, the 15-day band, okay, out of those 93 occurrences, got struck 17% of the time, almost 6% less often. So on the upside, the bands got struck across the board a significant amount less often than normal. The lower bands got struck less often, although not as much of a difference. You know, the 15-day band, 11% difference. But again, what we see across the board here are all 6 bands getting struck less often. This is a picture of lower market volatility. Now, of those 93 occurrences, there were 57 times where price exceeded the previous day's high. So it would be like price exceeding today that inside bar on Friday to the upside. It would exceed that inside bar's high. If that happens, and in those occurrences, of those 57 occurrences, all right, all 6 bands got struck less often, as you can see here, by a significant amount. And in the instances where price went below that inside bar's low, went underneath it, significant amount of difference between the benchmark and then what these bands got struck, how often these bands were struck. So across the board, a picture of lower market volatility. Finally, let's go and look at what happens when we recast those distribution bands using a skew-adjusted VIX volatility input. So when we say that the band is set a standard deviation away from the close, well, how far is that? Well, when we use statistical volatility, that gives us a certain value, a certain number. Well, whenever we use the VIX tends to be a higher value than the 20-day statistical volatility. So then, because it's a higher value, those bands are going to be farther away. And then, as you can see here, the benchmark is that those bands are going to get struck less often. You see that? They're going to get struck less often. Instead of 23 to 30% of the time, when in the case of this, they're getting struck 16 to 22% of the time, something like that. But similarly,